For over 120 years, STBB, the big small firm, has been delivering legal solutions to South African business and personal needs. And in our ongoing Legally Speaking series, property law expert Belinda demystifies and explains in layman's terms aspects of the law. Today, capital gains tax. Belinda, tax is always a tricky topic, perhaps a bit off-putting and scary and not the most exciting if we are to be honest. But what do you feel is the most important thing which property owners out there need to know about capital gains tax?
Hello, Mark, and it's good to be here. Thank you. It is tricky and quite complex, and even trying to reduce it to bite sizes today and shorten the explanation to the time that we've got is near impossible, really. So I think what I want to achieve today here with you is to get the listeners and the taxpayers out there to think about a number of aspects as applied to them and their property dealings and ownership. So to answer your question in a nutshell, they need to know that it applies to each and every property sale, as it does with the sale of other assets like shares, etc., but whether it is payable in terms of the calculations still to be done for that tax year, and if so, how much, is another thing. And that will all depend on a bit of information that I'd like to share today. So, very important to note that as purchasers of property, the vehicle you choose to take transfer of the property will impact directly on the capital gains tax payable if and when that property is sold later on, or for that matter, if it is in your name still when you pass away, or in the name of a trust, for instance. Linked to that, of course, is estate duty, and that is a separate discussion and topic for another time.
So, into the nuts and bolts then, what are you paying tax on as a seller, and what is the calculation most basically explained?
Right. Most basically put, capital gains tax is payable on the net capital gain realized when a property is disposed of, the formal term that SARS use. And disposal includes not just a sale, but other events such as donation or death and others. Today I'll focus on sale in the short time that we have. In reality, it is a bit of a misnomer, capital gains tax, Mark, and not a separate tax, as once the net capital gain on the sale has been calculated and any exemptions applied to that amount, only a portion of that amount is included as normal income for the tax year in question and taxed at the rate that applies to that taxpayer. So a percentage is kind of hived off and added to the taxable income, or will then, if no other income is arising for the tax year for that taxpayer, constitute taxable income for the year for which a tax return must be submitted. The receiver only looks to tax the net gain, which was realized after 1 October 2001, when capital gains tax came into effect in South Africa some 20 years ago. There are 3 methods available to determine the value of the property on 1 October 2001. If it was acquired before that date, as happens often, I see many people who have owned properties for well over 20 years, and I have no doubt a number of your listeners will fall into that category. I won't go into the 3 methods to determine the value, but assume that there are reasonable methods which the tax practitioner will know about, which have been employed, haven't changed, and have been effective the last 20 years.
So how do you actually get to that number then, that net capital gain?
Okay, so you would take the selling price of the property now, less what's called the total base cost figure, which will give you that net capital gain amount. Now, only a portion, to reiterate, of that is taxed, not the whole, but the first step is, how do you get to the base cost? And then, what portion of the gain is taxed? And finally, at what rate? So, back to arriving at base cost. There are, in essence, 3 categories of deductions being allowable capital expenditure. the taxpayer can use to reduce the gain made between the selling price now and value of the property as at 1 October 2001 or the purchase price if it was bought after that date. So these categories of deductions are 1. Acquisition costs. We're talking transfer fees, bond fees. 2. Improvement or renovation costs, which speak for themselves, but remember, cannot be repairs or maintenance items. Only those that added value and were capital in nature. And 3. Disposal costs, and there we are looking at your agent's commission and cost of compliance certificates. Now note that this capital expenditure must be supported by invoices and proof of payment, naturally. And those 3 categories are added to either the value of the property as at 1 October 2001 as determined by the 3 methods I spoke of earlier, or added to the purchase price of the property if it was acquired thereafter. And then that amount, totally comprised, is known as the base cost of the property, which is deducted from the selling price to arrive at the net capital gain. Now, most notably, there is a big difference if the property is owned by a natural person or individual and if it is their primary residence. I'm sure most of your listeners will know that SARS offers tax relief, and thank goodness, and an exemption on capital gains tax payable if the property they are selling is their primary residence. And SARS gives a 2 million primary residence exemption off that net capital gain. SARS also grants to individuals and special trusts a once-off annual exclusion in respect of a capital gain made of 40,000 Rand, which isn't very much but worth mentioning, which increases to 300,000 in the year of the taxpayer individual's death. It's a once-off sum, I must mention, per year and not per property owned and disposed of in that year, and certainly not per years of ownership of that property which they're disposing and calculating the capital gains tax on. I am asked that frequently, so just to clarify that. Now, to the taxation part. I mentioned earlier that only a portion of the gain is added to taxable income for the year, and that portion is called the inclusion rate. It is not the same for property which is owned by a natural person or individual versus a juristic entity, which is your companies, closed corporations or trusts. Because with individuals, SARS take 40% of the net capital gain after the allowable exclusions, and they add it to the taxpayer's income of that individual. With juristic persons, SARS take 80% of the net capital gain and tax it at the rate that applies to the juristic person. So, Mark, ultimately, capital gains tax is lowest for an individual disposing of property. And even with individuals, it ranges from individual to individual depending on how they are taxed and depending on the amount of the gain. It's highest for a trust selling, for instance, with companies and closed corporations in the middle of the two of them in terms of their effective capital gains tax rate. I think that's enough for today, and what I would like to do in our next session is speak in more detail about these various entities, the rate of capital gains tax which applies in the event of a disposal of property by them, and also death, how that impacts, when it is payable, whether it's payable by the deceased, by the surviving spouse, things like that I would like to go into, and general considerations in that regard.
We're speaking to Belinda Lewis, property law expert with STBB. In the meantime, Belinda, if anybody would like to contact you, can you give us your contact details, please?
Certainly. Well, I'm at the Claremont branch in the southern suburbs. We do have 11 branches nationally with over 100 professionals in the company. So we could be reached via our website, which is www.stbb.co.za.